What's up YouTube? I'm Casey with bestinvestingapps.com, and today I'm going to be walking you through a tutorial of how I am creating and preparing a more defensive portfolio in M1 Finance in preparation for any potential swings in the market that may be coming up. I'm going to walk you through how I'm doing it, why I'm doing it, what I'm putting in there, as well as why I am creating this at this time. If you like this video, go ahead and subscribe. We're making more videos almost every day. And of course, stick around. I'll be giving out some free copies of my ebook, Invest, 3 Easy Steps to Investing. And without further ado, let's get right into it. Here we go. So I am going to walk you through my process, my strategy, and my method step by step. And then at the end, I'm going to tell you a little bit about the drawbacks and the flaws both in the plan and in my research, as well as why you may or may not want to use this yourself. Of course, I don't know you or your investing needs, so this is not a recommendation. You do still need to do your own research, but hopefully this gives you some ideas and clarifies why I am changing over to a more defensive position at the moment. I created this strategy for myself as a solution to my kind of midline balance between index investing and a more active managed style. I sort of fall right on the middle of the fence. I have one foot in both schools of thought. So I created this strategy where I have a portfolio which moves from aggressive to defensive based on one major market indicator. And we're going to talk about what that is and why I've chosen it. I wanted to create a way to adjust my portfolio to account for rises in the market that could potentially lead to a market correction. Now, the market always moves in cycles. It always goes up. It's always going to come back down. However, it's been shown time and time again that it's almost impossible to predict exactly when that's going to happen. So I started thinking, instead of trying to predict exactly when it's going to happen, why don't I just move into certain assets that are likely to do better when the market goes down as the market climbs? So I settled on using the price to earnings ratio of the S&P 500. Now the PE ratio, price to earnings ratio, is a measure of how expensive the market is as a whole. It is the price that people are paying per dollar of earnings for the investments they're in. Right now we're sitting at 25.79. Historically, the market average is 15.66. So we're way above average. With a minimum of 5.31 and maximum of 123 in March of 2009. That was at the worst, at the bottom of the Great Recession. Some crazy things happened there, so that data is way skewed, but it just goes to show that things can go crazy. Now, let me pop over to a different variation of the PE ratio. You can see that sitting here on the top of some of these big peaks in PE, as the market climbs and climbs and climbs in price, it climbs in price. Boom! All of a sudden, it's so inflated. Of course, there was a lot of different factors at work during the Great Depression, but bam! It just shoots to the bottom. And again, here we have Black Monday, which was a little bit different scenario caused by different turmoil. And here is the Great Recession of 2008-2009. Boom! It comes back down, and here we are today. If that doesn't look like we're kind of on the top of a precipice to you, I don't know what does. It definitely looks to me like we're heading up at a very rapid rate, and there's a pretty good likelihood of some kind of correction. I'm not saying that it's going to be a world-ending correction, but I am saying that it's indicative of the market beginning to get to the point where I want to become more defensive. So that's why. Now let's look at how. Because the market returns tend to coincide with large changes in the PE ratio, I decided to try to come up with a strategy where my portfolio can change based on the PE ratio. So I went and gathered all the data I needed, came in, and here we have the PE changes around the tech bubble burst and the Great Recession, and we have the returns of the market as a whole. So we have negative returns here through the tech bubble. And then we have a big negative return in 2008, a big positive return in 2009, which is actually a little bit off. We have a PE spike here in 2009. And so according to this, actually, that's kind of an indicator to me that it might be a lagging indicator. The PE may change after major changes in the market, but we're going to test it and see if it works anyways. So we're going to come in and we're going to create a portfolio that buys gold as the PE rises, and it's going to sell stocks as the PE rises. Of course, as that reverses, it's going to do the opposite. So here's the PE ratio along the bottom, and here is the allocation. So red is gold, blue is S&P. Today we're at 25.79. According to my strategy, 25.79 means I should have 20% in gold, 80% in stocks. Let's go to M1 Finance and let's build that portfolio. Let me be clear that what I'm trying to create here is not a day-to-day or a week-to-week way to beat the returns of the market. What I'm trying to do is hedge my portfolio against huge black swans or unexpected changes in the market, which I think may be tied at least somewhat to huge rises in the PE. So that's my hypothesis, my suspicion. I'm not trying to do a day trading strategy. I'm not trying to time the market every single day. All I want to do is begin to become more defensive as PEs reach levels that I feel may be unsustainable and could increase the likelihood of an upcoming change in the market. The easiest way for me to do this is with M1 Finance because there are no commissions and it's actually also free to use under $1,000. Has a lot of value and it trades within a one-day window every day. So I can change between assets every single day without having to rack up commissions, which would kill me. So I'm going to come in and I've already got this portfolio built. It's called Defensive Shift, but I need to put in 20% here to the iShares Gold Trust, and I need to reduce the rest of my exposure to 80%. So I'm going to do 40 here and 40 here. I chose to do VTI and VPU to take advantage of the fact that utilities tend to sink a little less. For instance, here in 2008, utilities went down 28%, S&P went down 37%. Make no mistake, utilities still went down 28%, but they were about 9% better than the rest of the market, which I guess is okay, depending on how you look at it. It's better than nothing. So I'm going to leave VTI in here because there's a good chance the market will still continue to run up for a while, and I don't want to miss out on that. So I'm going to start adding a little gold. I'm going to start reducing my exposure to the market. I've chosen utilities because they perform a little better when things go down. They also climb when things are going up, so they kind of give me the best of both worlds. And I'm going to save these changes. So now I'll have updated stats, average expense of 0.11%, which is maybe a little higher than some things, but not bad for a 2% dividend yield, 3 holdings, and the potential to outperform the rest of the market by about 16%. So here at the end of the article, we compare the dynamically weighted PE portfolio versus a straight S&P index portfolio. And the portfolio that I'm using here as a defensive portfolio actually outperformed a index portfolio by a good margin, about $7,000 over the course of 98 to 2017 through both major market corrections. So I think that's pretty cool. I'm going to continue testing. I'm going to use this, and I am starting to move that way. So hopefully this got you thinking. Hopefully this introduced some ideas. And hey, feel free to leave me some comments. Tell me what you think about it. Let's get into some of the drawbacks of this system, and I'll tell you a little bit about the flaws in the research and some of the drawbacks. One of the biggest drawbacks to this system is that it's much more effective on a quarterly or biannually basis. If we go back up to the top and we take a look, we can see that usually the changes in PE kind of happen either at the same time or even sometimes after a major market correction, which can be hurtful, but it actually outperforms anyways because investors tend to flock into gold after the market has already crashed. So the market crashes, people freak out, they pull their money out at the bottom and they put it in gold. And by the time the PE responds, people are starting to buy into gold. Well, that actually allows the portfolio to take advantage of the upside. So that may actually be an okay thing. I know it's one of the flaws in the system. The second flaw I want to talk about is the fact that, according to the article, the allocation is either S&P or gold. Now I started putting in some utilities, and that kind of takes out some of this. You could add consumer staples and other things. One of the reasons you don't want to go just gold, or at least I suspect that I wouldn't want to use just gold, is in case something also happened to the gold market. That would really kill any returns. It could kill the whole portfolio. So going just into gold as a hedge against a downturn, well, maybe something massive happens to gold as well, and that could really kill the whole thing. So having more than one allocation on the defensive side would be good. The other thing that will improve this portfolio overall, and I did do some back testing on it, is a more frequent reallocation on a 3 or 6 month basis rather than annually. So check the show notes below for the link to the full article. You can read through the whole thing and fully understand it. If you still have questions, leave a comment over there on Best Investing Apps or on this video. If you have ideas or thoughts, please share them. I love hearing everybody's thoughts. And remember, again, this is just an idea. This is just something that I created to solve some problems for me. And it works for me. It might not work for you. Take away some good ideas. If I helped you out, give me a thumbs up. If you want more videos, make sure you subscribe. I'm doing more videos almost every single day. And we're going to be doing more videos like this where we take a deep dive into areas of investing that are a little more removed. Feel free to use my sign up link down below if you sign up for M1 Finance. It's the perfect platform for this method, and I absolutely love it. I recommend it for many reasons, not just because it's commission free, but there are many advantages to using M1 Finance. So I'll see you next time, and I hope this helped everybody out.